Welcome to our International Financial Management course lectures. Today we will talk about Basel Banking Accords. Let's begin. The Basel Accords are a critical set of international banking regulations established by the Basel Committee on Banking Supervision, which operates under the Bank for International Settlements to oversee global banking standards. These accords aim to standardize banking practices worldwide, significantly reduce systemic risks in the interconnected financial system, and promote enduring global financial stability for banks everywhere. They primarily focus on key areas like capital adequacy to ensure banks hold enough reserves, supervisory review for ongoing oversight, and market discipline through transparency, evolving significantly over time through multiple iterations. Basel I, introduced in 1988 amid the 1980s banking crises, sought to strengthen the international banking system by establishing minimum capital levels based on risk-weighted assets. It focused primarily on credit risk, mandating that banks maintain capital equal to at least 8% of their risk-weighted assets, divided into Tier 1 core capital and Tier 2 supplementary capital. Assets were grouped into risk categories such as 0% for government bonds, 20% for some mortgages, 50% for residential mortgages, and 100% for corporate loans, based on perceived risk levels, though this approach had notable limitations. However, Basel I did not account for important market risks or operational risks, and it was widely criticized for its overly simplistic approach, which unfortunately encouraged regulatory arbitrage by banks seeking loopholes. Basel II, launched in 2004, refined its predecessor by introducing a more comprehensive risk management framework structured around the famous three pillars approach. Pillar 1 expanded minimum capital requirements to encompass not just credit risk, but also market and operational risks, allowing banks to choose between standardized methods or more advanced internal ratings-based models. Pillar 2 introduced the supervisory review process, empowering regulators to thoroughly assess each bank's overall risk management practices and capital adequacy beyond just formulaic calculations. Pillar 3 emphasized market discipline by requiring detailed public disclosures of risk exposures and capital positions to enhance transparency and accountability in the financial system. Despite these advancements, Basel II faced substantial criticism for its increased complexity, heavy over-reliance on external credit rating agencies, and its unfortunate failure to prevent the devastating 2008 global financial crisis. Basel III, developed in 2010 directly in response to the lessons from the 2008 financial crisis, aimed to significantly strengthen both bank capital requirements and liquidity positions worldwide. Key features included higher quality Tier 1 capital ratios such as 4.5%, Common Equity Tier 1, additional capital conservation buffers, countercyclical buffers, and a non-risk-based leverage ratio to effectively cap excessive borrowing. It also introduced crucial liquidity standards like the Liquidity Coverage Ratio, which requires banks to hold sufficient high-quality liquid assets to survive a 30-day stress scenario. Additionally, the Net Stable Funding Ratio was introduced to ensure banks maintain stable funding sources over longer terms, thereby enhancing overall financial stability. While these measures greatly strengthened bank resilience against shocks, Basel III also led to higher compliance costs for banks, and in some cases, reduced profitability and lending capacity. Basel IV, finalized in 2017 and set to be phased in through 2028, builds further on Basel III with additional refinements to address remaining vulnerabilities. It notably revised the standardized approach for credit risk calculations to reduce excessive reliance on banks' internal models and introduced a binding output floor mechanism. This output floor ensures that risk-weighted assets calculated using internal models cannot fall below 72.5% of those derived from the standardized approaches, promoting consistency. Basel IV also promotes greater global consistency in regulations to minimize regulatory arbitrage opportunities and expands coverage to include interest rate risk in the banking book. Ongoing debates persist about whether these stricter rules might constrain lending activities or instead substantially improve systemic stability in the long run. Ultimately, the Basel Accords serve as a cornerstone of modern banking regulation, continually evolving in direct response to financial crises and shifts in changing market structures over the years. For future financial managers, understanding the principles and implications of these accords is vital for effectively analyzing banking stability, managing systemic risks, and navigating international capital flows in a regulated world. Thank you for watching our lecture on international financial management focusing on Basel Banking Accords. See you at the next lecture.